Hello and welcome. You're watching Countdown on Bloomberg Quint Live. Let's just cut in through the press conference of IndusInd Bank. The press conference will just start in a while on IndusInd Q3 numbers. Remember the net interest income, which has been pretty much in line, up almost 20% for the quarter, and a mild bit of uptick that one has seen when it comes to the asset quality for both the gross as well as the net NPAs for the quarter have seen a mild uptick. And as you can see, the stock probably may have reacted negatively because of the deterioration that one has seen for the asset quality. But net, I guess the numbers have been pretty much in line. It's just the asset quality figure which may have disappointed the street, because if you look at the net interest income, now that's been pretty healthy and it's been pretty much in line what the average street estimate was this time around for IndusInd Bank. The NI for the quarter has been up almost 20%, and we'll have the management talking about their numbers just in a while. As you can see, they're already seated and they will start taking the media through their quarterly performance this time around. But I think it's the first earning which has come from the banking space. The numbers are pretty much in line, is what we can see as of now. 1720 is the level where IndusInd Bank is currently trading, a downtick of almost about 14 rupees. I just want to highlight, in the month of October, remember they had announced their merger with Bharat Financial. Post their numbers, a bit of reaction has been seen for the stock price of Bharat Financial also, I guess, a bit, but we'll get more details on that front. But I think we'll cut into the press conference in a while right now, and the stock of IndusInd is not reacted much. I think it's just holding about to those levels. The Q3 NIMs are at 3.99 versus 4. So there also sequentially you can see a bit of reaction which has come about right now. The NIMs are at 3.99, and in the corresponding, the sequential quarter, the net interest margins were at about 4%. So remember, this is an important number which the street watches, for any banking counter right now. So the NIMs have been pretty much stable, but a mild bit of downtick has been seen if you compare the numbers sequentially. 3.99 versus 4. CASA ratio at almost 42.86% versus 37% right now. That's been flashed on your screen, the CASA ratio for the third quarter. And Neeraj, if you look at the numbers overall, I think the stock reaction could be negative, and I guess what may have disappointed the street is the asset quality and the net interest margins for the quarter.
Yeah, but this would be also maybe just a temporary move, Navneet, if you will. I mean, it's just about less than 1% down. So not really a big cut there. I mean, all your arguments are valid. Let's just wait and watch what the management has to say about how the asset quality shapes up over the course of the next quarter, and therefore for the year as well. I think integration commentary on Bharat Financial merger as well would be very, very interesting to watch out for. Let's hear out what the management has to say. Bank and Ramesh Sopti might just start talking. So that's the numbers, of course. While we just wait for IndusInd Bank to come out, I need to address that the equity markets are doing rather okay for themselves, about 0.25% higher for the Sensex and the Nifty. So pretty much in line with what the markets have been doing for the last hour and a half. So no changes there whatsoever. And not that banks are participating in a big way, but just IT seems to be in full gusto. So ahead of numbers, the Nifty IT names are certainly trading with a fair bit of green. Infosys leads the pack, Tech Mahindra follows suit, and a couple of others like HCL Tech are not doing too badly. So those are a set of stocks which you need to watch out for. From amongst the financials, it's Kotak Mahindra Bank, which is up about 1.5%, so good going there. And Indiabulls Housing Finance from the NBFC space is the top leader on the Nifty. So those are a few names. We'll just cut across to IndusInd Bank once our production control group tells us that the management has started speaking. Let's just mark some of the stocks as well and just show you what's really happening with the large cap universe. So as I was saying, Indiabulls Housing Finance up about 2.5%, Infosys about 2%, Tech Mahindra about 2%. Bharti Airtel and Bosch have some gains, about 1.25% as well. Adani Ports about 1%, Asian Paints about 1%. A fair bit of green on the screen, just being offset by losses to, I presume, ICICI Bank, which is down about close to 1%. Vedanta continues to go down, and TCS about a third of 1%. So after a big move in trade yesterday, TCS is down about a third of 1% as well. Pradeep, what else are you spotting?
So that's not really a cause for concern so far as the banking sector is concerned. Small blip that we have seen in the NPA numbers of IndusInd Bank, and we are still waiting to see what happens next with the banking sector. But let's look at some more stocks that we have been watching out for. The crude theme continues to play out even today. Aban Offshore is a big gainer on that theme. If you look at by around 9% when I checked it last, I think, yes, 9.5%. So quoting very close to day's high. IDFC Bank and Capital First both continue to move. So these are two more names to watch out for interestingly in the financial services space. And also IFCI, the PSU player that is moving up. There was some bit of stake sale announcement earlier this week, and the stock continues to move up. Marksans Pharma would be another name to mark in the same space. Very few losers today though, but we must look at one that is Fortis Healthcare, down by around 7% with good volume after rising for several days, is correcting now. This is one key loser in today's trade so far that we have marked. Otherwise, market breadth remains good. Orient Paper would be another stock I think that we should address today. Is down. It will show you, a decline of around 70%, but actually this has gone ex demerger, and therefore what you have now is only the paper business. And if you wanted to bet on Orient Lighting or the Orient Fans, that electric equipment company will be listed separately, and each shareholder who has been holding this stock yesterday will get that share separately as and when it gets listed or relisted. So we'll have to wait for that. So this is not really a fall in this stock price. Dredging Corporation is another key loser in today's trade, down by around 5% now. I think now we can go across to the IndusInd Bank management and see what they have to say.
I think just waiting, but maybe Swati Kulkarni is here. If we can take an initial couple of thoughts from her, because she's been waiting by as well. Executive Vice President at UTI Mutual Fund joins us right now on the show. Swati, good having you. Thanks so much for joining in. The IndusInd Bank management might start speaking anytime, so we'll have to cut across there. But just while we wait for that to happen, your initial thoughts on how do you expect this earnings season to shape up? I mean, can it justify the kind of valuations fundamentally that we are trading at currently? Or can it at least show the beginning of the course?
So speaking about this quarter earnings, if you look at from a YOY basis, there is definitely a favorable base that we are getting into. We had demonetization last year, the same quarter. But you look at the sequential numbers, then you have an post-festive quarter. So you will have to look at from a YOY perspective, and if you look there, I think things are looking brighter for many sectors which are driven by consumption, and also we would expect some bit of momentum picking up as far as the revenues are concerned in the traditionally stable earnings kind of names. So we expect retail banks to continue to post the growth that we have seen. We also expect FMCG consumer discretionary to start showing a pickup in demand if you compare year on year.
Okay, Swati, just stay on please. But the IndusInd Bank management has just started talking, so need to cut across to Ramesh Sopti.
In the balance sheet by 25%. We've seen an increase in our return on assets. So the ROA actually went up from 1.90 last quarter to 1.96 this quarter, and 1.88 last year, and so has the return on equity as well. So the returns have moved up as smartly as the growth in the balance sheet, which means that the revenue and bottom lines have kept pace with the growth in the balance sheet. There are two star features of the performance during the quarter. One is the growth in the savings bank base. The savings bank grew by 68%. So you've seen now for 4 or 6 quarters that the savings bank is growing in the 40s or 50s, and now 68%. And year on year growth 68%, and CASA is nudging 43%. That's one part. The other part is, of course, vehicle finance, on which lots of questions are asked every quarter. Vehicle finance is now beginning to go into a sort of a boom situation. We saw a 34% increase in our disbursements on overall vehicle finance. And if you were to look at only commercial vehicles, then commercial vehicles disbursements grew by as much as 39%. And the growth is pretty secular. So it's not just commercial vehicles, it's two-wheelers, it's three-wheelers. Tractors actually shows a very strong growth as well. So the loan book outstandings are back now in the 20% range. So vehicle finance is, and that's why you are now beginning to see us move the needle a little bit in favor of retail versus corporate, and retail is now moved up about 1 percentage points. In terms of margins, net interest margin remains the same, flat at around 4%, 3.99 to be exact. Capital adequacy actually improved during the quarter, and we are at 15.83% because of the quality of the loan book that was originated during the quarter. So if you grow 25%, how does your capital increase? The capital should reduce. It only increases if your quality of loan book and the risk weightages fall. And that is exactly what has happened. So we are moving towards a qualitatively better loan book, and that trend we have seen over the last 4 quarters as well. Cost to income ratio is flat. Return on assets I've already talked about. And net NPA, gross NPA moved up by 8 basis points, but the credit cost fell by 3 basis points. Credit cost is actually down from 18 basis points to 15 basis points, and net credit cost is 14 basis points. If you analyze this, then we are the credit cost is well within our stated objective of 60 basis points for the full year. Other than that, 5 lakh new customers were added during the quarter. The customer base of the bank has now moved up to 11 million customers. Out of this 5 lakh, 3 lakh were savings and current account customers. So our run rate on new customers has also moved up nicely. The digital part of businesses, this question always raised, and we have targets internally for digital sourcing. So we are very happy to see the robust momentum there. So 25% of the savings bank's accounts which were booked afresh during the quarter were through tab banking. 14% of our credit card originations were online as well. 64% of our personal loans were pre-approved, which means also online. And there's been a massive traction also in our mobile banking transactions, which are now at 1.5 million customers, which has grown 3 times over the quarter. So the digital part has also gone off pretty nicely. Balance sheet growth is also steady. Deposits grew by 23%, and the loan book grew by 25%, in which the corporate part grew 26%, and the retail part grew at 24%. So retail, if you've seen over the last few quarters, was around 19-20%. Now it's moved to around 24%. So retail is also now tracking well, and soon I think the book will be balanced in terms of growth, etc. So other than that, I think the only other news we have to share with you that the stock, which was already included in the Nifty 50, was also included in the Sensex for the first time. So that's a quick summary of the quarter's results, and more than happy to answer questions.
Already pointed out the segregation in demand. If you could tell us which pockets where the store demand coming from?
Yes, so if you look at retail, I think we have already discussed that the vehicle finance started moving very robustly, and vehicle finance grew overall by, the loan book grew by 20%, whereas the disbursements grew by 34%. Other than that, the non-vehicle retail book also grows in the 40s, in the 40%, but that comes off a smaller base. So that's on the retail part of our businesses. The microfinance part also has started moving as well, and microfinance portfolio has now crossed 3,000 crores. So that's on the retail part. On the corporate book, of course, we are seeing pretty good traction now on working capital. As we have said, for the last 2 quarters, we are seeing that. And we are also seeing a little bit of what we call brownfield expansion. So it's capex not for new projects, but capex for existing projects. We are certainly seeing some of that. We've seen some capex already happening in power transmission, for instance, and those areas. So it's pretty evenly distributed, both on the corporate side and all the retail side.
Where is it coming from? And one of the things in the is the evidence of floating provisions. Could you explain a bit what is that?
Yeah, so I think 2 quarters ago we had made a floating provision. We had surpluses available with us. Instead of showing them in profit, we had made a floating provision. A floating provision of 70 crores is still outstanding, and we have maintained a provision coverage ratio of 60%. The 8 basis points increase in GNPA is not from a particular account. It is just spread out a little bit on small amount, 20 crores is on, say, loan against property, little bit on commercial vehicles, little bit on the corporate side. So it's not a noticeable movement of just 8 basis points, but credit cost actually fell. So the hit to the P&L was lower than last year.
Well, that was Ramesh Sopti of IndusInd Bank, and if you were listening to it, loan against property and commercial vehicle, these are 2 segments that management has identified as key sources of fresh NPAs. So if we were really worried about rising NPAs by some 8 basis point, though it could be significant for a bank that has managed to keep the NPAs close to 1% mark in longest of times. But management has also clarified that these are a few segments and there is no one large account as one may fear, as we have seen in case of other banks, that one large borrower turns NPA and therefore there is a jump. So that is not the case, but these are 2 smaller segments which have probably contributed, not so small a segment for the bank, but in terms of the entire banking sector that have really contributed. IndusInd Bank down by 13 rupees or so, recovering from lows actually. Shall we move on? Swati Kulkarni has been waiting by. Swati, coming back to you, 2 key segments that IndusInd management has identified, some loan against property and commercial vehicles. Do you think this could be a pressure point for other banks as well?
Yeah, so as far as I think loan against property is concerned, we are seeing competitive intensity increasing in this segment for last almost more than 1.5 years. And so that was always a place where you could see some kind of slippages. As far as I think commercial vehicles is concerned, there also the growth has been pretty strong. So when you look at on the ratio compared to what NPAs are versus the loan book, I think that won't be that alarming as yet. So I would be little cautious about loan against property than on the commercial vehicle side, because there is also an expectation of a pickup in economic activity which should help the commercial vehicle segment.
Ma'am, what's the kind of earnings growth that you're expecting from the Q3 earnings? And also tell us for FY19, what sort of earnings growth will you be watching out for?
I think this quarter the earnings growth is expected to be in the double digit, and I think that would be after maybe 3-4 quarters of lackluster growth. That's again when I said it is based on the base effect, as well as you have certain sectors like consumer discretionary continue to do well, as well as the private sector retail banks, they are also expected to do well. Now in terms of the next year's assumptions, the forecasts are anywhere between 20% to 25%. But I think going by the trends that we have seen in last 3 to 4 years, that you typically estimate a much higher growth rate and there is a downward revision to the earnings. The pace of downgrade is expected to be slower this time. So something like about 16 to 18% is what is probably a reasonable growth to expect on the larger indices. Largely this could be driven by the credit cost coming down as you get into the second quarter, and also you would expect operating leverage benefits to come for many companies which have capex incurred and assets are not yet utilized.
Right. The focus now shifts to
rural is another support which could come. Yeah.
Great, yeah. Everyone's been talking about the recovery in rural growth, and probably we'll get to see a glimpse of that at least in the earnings that we get from the FMCG pack this time around. But I was coming to the union budget. The focus for the markets will now shift to that. What are your key expectations? Because there are a lot of talks to shore up the revenue. Government may start levying LTCG2 this time around.
I think budget is not going to be that big event now, because indirect taxes are now carved out through GST Council, and for direct tax also I think the direct tax code related task force has been set up. So I don't expect much on the taxation front in this budget. Well, there is this debate around long-term capital gains tax every time the budget approaches. But from a perspective that the equity is an important asset class and you need to incentivize people, I think concepts like how do you incentivize for long-term investments in equity could be welcome.
Okay, and what do you think will be the focus of this budget, and which sectors, segments in equity market do you think will benefit?
So as I said, the focus on the budget, in fact, the market would be looking at more from a macro perspective, because the 3.2% target for fiscal deficit is likely to be not achieved, and there could be slippages mainly on account of the transitionary year that we had to a largest reform in the country. And also you have less surpluses transferred from RBI. So the impact of this is likely to be felt, and I think market participants are already expecting this, and you have seen bond yields tightening around this fear. So I would suggest that the focus would be more on macro. You have crude prices also rising, and that putting pressure, if not on currency right now, but eventually that could put pressure on the trade deficit as well as some pressure on currency. So I would argue that we are coming out of a 2017 which was more of a complacent event across the globe, with synchronized growth and equity markets doing well across. People not much thinking about the volatility in the market. So now we have to be geared to a situation where interest rates globally are rising. Inflation in India is inching up, and we have very limited room as far as interest rates are concerned. So I think we should be much more geared now for the volatile markets than expecting that things would be as smooth and as less gyrated as it was in 2017.
Okay, we'll let that be. Thanks a lot for that, Swati. Thanks for waiting patiently for us as well today and giving us your thoughts. That's the view from Swati Kulkarni of UTI. Some stocks may not move, but JVL is certainly a stock that is moving. It's trading with gains of almost 20%, returns of over 100% in the last 1 year as well. What been the key factors at play for the business to do well, because of which people might be looking to go out and buy the stock as well? Let's get in Adarsh Junjunwala, whole-time director of the company. He joins us right now on the phone line. Good having you. Thanks much for joining in. Can you tell us a bit more about JVL Agro? Because we do know that the company is engaged in the manufacturing of vegetable oils and fats, vanaspati, refined oil, etc. Is that the primary nature of the business, and how is business doing for the last 6 odd months?
Hi. Thank you very much for having us over, and thank you very much for providing this opportunity. JVL Agro, actually, this what you mentioned is a refined oil and vegetable fat. This is a dated information. JVL Agro has started to transform itself into a brand-based food company since the last 2 to 3 years. And as on date today, if it is selling about 3,500 crore of food products every year, 95% of that is only and only under a brand through the sales and distribution network that the company has created for itself. So, though, yes, the major products that it sells are vegetable oil, but as I mentioned, it is a brand-based food company, which is the target for the company for the next 2 to 5 years. Along with vegetable oil, the company moved itself into rice, a premium quality non-basmati rice, because India is a huge consuming market for a product like rice, and we felt that there is no brand available in the market in the non-basmati segment. The basmati segment is pretty crowded, but the non-basmati segment has nothing. We have also started to get into pulses. Branded pulses is another segment which is being left untouched by a lot of other companies. So that's another opportunity that we have started to focus and work on. So as I said, over the next 2 to 3 years, you will gradually notice that the company has transformed itself into a high-value branded food company, and that is the outlook for the company. And I'm glad that the market is realizing it is not a commodity company anymore. It's a brand-based company.
Mr. Jhunjhunwala, well, the going's been really good for the stock price of your company, but I'm just looking at the financials, the first half. The picture is not looking that great. Your profits in the first half were down to 11 crores versus 21, which was seen in the corresponding quarter. Also, I can see the finance cost is pretty high. If you could tell us what's the current picture, how's the second half looking, and also if you could just tell us what's the total debt that is there on the books?
So, well, as far as the long-term debt of the company is concerned, the company has only 60 crore of long-term debt on an asset block of about 500 crores. So the company is very thinly indebted in terms of the long-term debts. The rest of the debt that the company has is basically working capital debt. Now, when the business model of the company is being transformed, there is a bit of a reorganization being done on the debt side of the company as well. So you will see a bit of a hiccup here and there, but all of that in the long run is going to pay off very, very nicely for anybody who believes in the company and the story of the company as in day to day.
So could you clarify? I mean, one, when will these temporary hiccups move out of the way? How would FY18 as a year look like, and how could FY19 look like?
So, well, there could be a bit of a shrinkage in the top line. As I said, the company has started to completely take itself off the commodity business and started to focus on the brand building. So there is going to be some bit of a hiccup in terms of the top line, and there could be some glitch in the bottom line as well. But over the next 2 to 5 years, if the outlook is, if there is somebody who invests for the long term, they'll definitely see some great results coming out of the company.
No, which is a fair point, Adarsh, but just wondering, how would revenues look like? One is investing, one is what the numbers will look like. So let's assume there is a bit of a downtick that comes in FY18, and I heard you mention that over the next 2 to 5 years, things will look good. What are the internal targets about what quantum of growth rates could happen on the top line as a result of the reorganization you're doing?
In the next 2 to 3 years, the company is targeting a top line of at least 6,000 crore, because the facilities or the capacities that the company has can easily take it up to a top line of 6,000 crore. We don't need to add any facilities for that. So 6,000 crore is definitely doable. Post that, along with that, the company is also, as I said, is moving aggressively into rice. In the last 2 years, our experience in rice has been quite fantastic. We got into a bit of a pulses business in the last 3 to 4 months, and we have had excellent results so far. The market feedback has also been very, very positive. So I can just tell you that 6,000 crore of a top line in the next 2 to 3 years is definitely doable for the company.
By entering into these new segments like rice or pulses, which you just mentioned, will that help your margins? Because you're operating in an industry where margins are pretty low. I can see in the last few years, your margins have just been in the range of 1.5% to 2.5%.
Well, as far as the net profit margin on the top line is concerned, yes, you may point out that the margins have been a bit thin. But going forward, as the company goes into more and more high-value branded items, the margins are definitely going to see an upside. Moreover, this is a fundamentally an industry which is a low investment, high turnover business. So if you were to look at a return on capital employed, you will...
So if I could ask you, what are the current EBITDA margins?
The current EBITDA margins as on date today would be about 3 to 4%.
3 to 4%. And what's the target by the end of this year and also for FY19?
Well, this year, as I mentioned, FY18 could be a bit of a blip because the company is going through a bit of a reorganization internally.
Okay.
18-19, we could definitely see the margins improving anywhere between 3 to 5%.
And just last question from my side. You said 60 crore is your long-term debt. What is the cash that the company is sitting on?
The company would have cash reserves. I will have to check on the exact number on that, but long-term debt of 60 crore is something I'm quite certain about.
Okay, one final question. So if indeed you manage to do in 6,000 odd crores by, say, in the next 2 or 3 years, and that's the target that you mentioned, I would presume that the bottom line growth would be higher than proportionate simply because,
for sure,
as you mentioned, you'll get into the higher margin segment as well.
For sure, for sure.
And you won't require,
sure, yeah.
and you won't require
correct.
any funds for the same.
We don't need any long-term debt for the same. We will definitely need help from our existing financial institutions as far as working capital is concerned. But as far as long-term debt is concerned, nothing.
Great. Okay, Adarsh, we wish you all the best. Thank you so much for taking the time out and joining us and giving us that perspective. That's Adarsh Junjunwala of JVL Agro. The management is hopeful of turnover picking up by entering into newer segments. Let's wait and watch. We'll move up on the margin front as well. The stock is certainly doing well, but
3 to 4% margins which you highlighted, I can't see that in the last. They've been posting margins only between 1.5% to 2.5%. So that's quite surprising. Let's see if they can post, that kind of margin. Maybe for Q3 he was talking about, but we'll have to wait and watch out for the numbers.
Okay. Beyond that, the markets though, Pradeep, Sensex 1/3% now.
Yeah, so in fact, both the indices have come off the day's high, but doing well. There is no pressure if you see what is happening over the last few minutes. And interestingly, the market breadth has also improved because in the afternoon, at some point, there was a lot of pressure on mid-cap and small-cap stocks. Let's move on and let's get in our experts. Sumeet Bagadia, Associate Director at Choice Broking, is joining us on the show now. Sumeet, first of all, what's your take on Nifty? Do you really see a trade?
Hi Pradeep, good afternoon. Well, markets are very strong. We are seeing new lifetime high levels on index and Nifty is looking strong only. Now immediately a closing over 650 will take Nifty to 10,700 levels and a final close about 10,700 closing over 10,700 will take Nifty to 11,000 levels in next couple of weeks. Overall, the index is looking very strong. Till that time, 10,600 levels are not taken away on downside. We should till the time 10,600 levels are not taken away on downside, we should be on buy side. So my expectation on index that we are soon we are headed for 11,000 levels and very soon we will see these levels. Existing long positions, one can carry existing long positions with the stop loss to be placed at 10,600 levels for the upside target of 10,700 and 750 levels in next couple of days.
Okay, and what about your stock call, Sumeet?
Well, a few stocks are looking very good to me. The first one is India Bull Housing Finance. The stock is looking good on charts. Immediately, it has support at around 1190 levels. So till the time 1190 levels are not taken away, one should initiate long positions with the stop loss to be placed at 1190 for the upside target of 1280 and 1300 levels in next couple of days. The second pick for the day is Kotak Bank. Private banking space is looking good to me. Most of the private banking stocks are looking good on charts. Now immediately looking at the Kotak Bank, it seems that from here on we can see a move around almost 40 to 50 points from present levels. 1015 is the current market price. I think one can initiate long position in Kotak Bank at CMP. If there is a dip of around 8 to 10 points from present levels, then that should be used as a buying opportunity with a small stop loss to be placed at 990 levels on lower side for the upside target of 1050 as the immediate target. And if 1050 is taken away, then we can see extended move till 1080 levels in next 3 to 4 days time horizon.
Okay, let's also bring in Jay Bala, Chief Market Technician at chaos.com, who's joining us on the show now. Hi Jay, good afternoon to you from India, and thanks a lot for joining us today. What's the call on the index now? We're touching fresh highs almost every day. What's the call on the index? And also take us through your top trading strategies.
Yeah, if you look at the index, the market is a bit tired, and it's not exactly blowing through resistances. We are clocking record highs, but it's not clocking 1% day or 1.5% day. That's the kind of thing that shows market strength. But this doesn't mean that you got to turn bearish. But with the index heavyweights, you got to be a little more measured in your approach. We had projected a level of 10,770 for the index. I think the market is inching laboriously towards those levels. So be a bit careful. Don't create index strategies that says you're going to get outstanding levels on the index in the short term. No, that's not how the index is going to work. The index is slightly tired. Let the index pull back, and and it's very likely that even the US markets are going to pull back. The markets are hitting important resistances on the S&P 500. So watch out on the index. This doesn't mean you got to go out there and get short. It's not as you can see. The market has been trying to create record highs, but record highs should tell you that they are just plowing through that. It's not happening. It's just inching on its way up. So the strategy for me for the individual stocks, Pradeep, we spoke about the head and shoulders pattern last week. Here are a couple of picks. Just watch out for this. My first one is ICIL, Indo Count. If you look at this chart, it made a excellent bottom around the September lows. From there, you can see it's clocked two right shoulders, and it's broken out above the neckline. And if you look at the chart, it's very likely that it's as I pointed out last week, it's reversing a downtrend, and it's very likely to go to record highs from current levels of about 135. I think the right shoulder is about 105. I think that could be a very good stop, and the stock is likely to go to record highs. But the point I made about the markets are inching slower, so be sensible about allocation. Your allocation has to be lower. It's not that every stock is going to move. Some stocks are going to move, and some stocks are not going to move. Then my second pick is again ICICI Prudential Life. This stock, once again, we have a second head and shoulder inverse head and shoulder pattern. I think from the levels of 407. It's going to go to record highs past 520 to somewhere 520 to 550. Again, if you look at this chart, you can see a clear inverse head and shoulder, and when it went past 400, it broke out above the neckline. So you have two head and shoulders pattern, and let's see how these play out.
Okay, so that's the interesting chart pattern that Jay is talking about, inverse head and shoulder. If you just look at the chart, the longer term chart, that 1 year chart that we had just fired, you can probably see two shoulders and a head when there is a bottom, and then the next bottom is much lower than that, but the third bottom, the third consecutive bottom, is actually a higher bottom. So that the lowest bottom is actually the head, and the two shoulders on both sides, which are higher bottoms actually, and that forms the inverse head and shoulder. And the neckline is actually the if you just draw a line connecting the intermediate tops between those 2-3 bottoms, then you get a neckline, and when the neckline is breached, that gives you a breakout. So that is what has happened. You can clearly see how both these stocks have been kind of oscillating in a range and then bottomed out. I think now everyone can probably see two shoulders and a head in both these charts, and there is an interesting breakout which is giving the targets that Jay just talked about.
Did inverse you see the two
head
shoulders?
And shoulder. Inverse head and shoulder. Now, I remember last week Jay was telling Pradeep that head and shoulders, he uses head and shoulders for stocks which are going down, and maybe the inverse head and shoulder for stocks which are moving up. So maybe on those lines.
It's more often a reversal pattern, but sometimes it's also a continuation pattern. So the pattern that we were talking about was actually a case of continuation and not reversal, but these two are the cases of reversal. So as Jay had mentioned last time, you are sure of your targets. The probability is much higher when it happens at the bottom. So the probability that these targets will be achieved is much higher because these head and shoulders are formed at the bottom.
Interesting. Well, our fundamental guest with two shoulders and a head above his shoulders, Nipun Mehta, market expert at Choice Broking, joins us right now on the show. Nipun, good having you. Thanks so much for joining in. Since we are talking about some patterns being visible on the insurance companies, at least one insurance company, let me start off with that, what's happening here? Some of these expensive stocks are finding favor. The likes of HDFC Life have inched up. Bala today identifying ICICI Prudential as one. But almost everybody seems to be betting on life insurance and ignoring the general insurance space largely.
Well, good afternoon, Neeraj. I think we discussed this on your show a few weeks earlier, that life insurance as a business, the penetration that is started now in comparison to the general insurance business is probably far faster that we are seeing really. Not just is the awareness higher, but that rural penetration that probably needed to come about is increasing thick and fast. At current valuations, probably most of them look at 70,000-80,000 crores of market cap. To an extent, they do look expensive if you look at it from purely from a March 18 or March 19 kind of earnings. But when you look at it on a longer term basis and the kind of growth that one is likely to see in the life insurance business, our sense is that probably this kind of traction is something that will continue for the life insurance companies. You might not see the same kind of traction happening for the general insurance business. That might be probably a few quarters away when there's greater penetration that really comes about. But our sense is the valuation differential will continue, and you are likely to see higher discounting happening for the life insurance business.
Okay, interesting. Nipun, stay on. We want to talk about IT as well. But, just before we do that, I think it's important to get in Agam to first give us a sense of what could be happening in TCS this time around. Agam?
Well, Neeraj, we're not expecting a very, should I say, a very exciting quarter because of the fact that we're expecting, at least about 1.1% growth when it comes to dollar revenues in sequential terms. And again, when it comes to rupee revenues, just about 1.7%. Reason is the seasonality factor which comes into play on account of the furloughs for this particular quarter. When it comes to margins too, we're just expecting, marginal expansion at around 25.3%. Consequently, profits could move up around 1.4% quarter on quarter. The key factors that I'm going to be watching out for in this particular quarter, of course, is going to be the fact that we're expecting a pickup in deal wins. So this quarter will be more about the commentary than the performance itself, especially in manufacturing and the retail verticals. Moreover, we can also expect positive commentary coming in as far as the BFSS vertical is concerned, as the US markets on the back of what we've seen and the kind of earnings that we've seen for Accenture. Finally, of course, the insurance vertical is likely to remain strong. We've seen strength in this vertical and we're expecting it to sustain its growth moving forward. And I'll be watching out for key commentary on a change in client trends and the requirements from TCS and its management.
Okay, so that's interesting. We'll watch out for TCS. Nipun, any thoughts here? TCS today, Infosys tomorrow?
Well, again, our view since the last couple of months or probably a little longer has been that IT as a space has definitely turned around. The kind of growth that one saw, low growth that one saw for the last 2 or 3 years probably is something that clearly has turned around. More importantly, for the larger IT companies, you're selectively seeing that growth was there in the bit-sized IT companies, but in large-sized IT companies, clearly the growth had slowed down. It might not go back probably to 18-20% levels, but I think you've seen a turnaround coming in from that 8, 10, 12% kind of growth that was there in the last couple of years or thereabouts. So you might see a higher growth happening. The kind of benefits that a lot of the newer business opportunities had thrown up hasn't really been able to been capitalized by the larger IT companies. But I think the point remains that 10-12% growth is something that's expected to change to closer to about 14-15% this year. So you might not be back at higher teen levels in terms of growth, but very clearly the turnaround has happened, and you are seeing sprucing up of balance sheets, buybacks that have happened, better utilization of cash that is gradually happening, and couple that with the fact that the visa issue gradually seems to be diluting in comparison to what it was probably a year back. So all of these factors showing up that you are likely to see better growth over the next 2 or 3 quarters, at least as far as the large cap IT companies is concerned. This quarter might not be exceptional because generally the December quarter isn't it doesn't necessarily show extremely high growth. But when you look at it from a 3 to 4 quarter perspective, I think very clearly IT as a contrarian bet looks to be at least a market performer, if not a market outperformer.
Okay, since we're talking about IT, let's also put spotlight on Infosys. Remember, that's the stock which is your top gainer in Nifty today. It has touched its fresh 52-week high. And after falling for each of the trading days last week, it has gained for all the trading sessions this week. And Pradeep is here with his chart check on Infosys. Pradeep.
So let's look at the daily chart of Infosys, and you'll realize that over the last 14 odd months, this stock has been trading in a range, so to say, at lower levels. It has not really been able to move above the higher end of this range. As you can see, that is placed at around 1050 odd levels. But interestingly, yesterday, not only it surpassed that hurdle at the upper end, but also closed above that. And today, we have maintained, above the highs of yesterday's range, really. So that kind of confirms a breakout above this congestion zone or a range trade that we had seen in Infosys since October 16. So that is almost a consolidation of 14 to 15 months. And now looks like Infosys is probably moving into a different orbit. To redefine its medium-term or longer-term range. That is an effort that stock might be making. What is also interesting is this has happened ahead of numbers, just 2 days before the result. The result is actually tomorrow, and yesterday we have seen this breakout. But what is equally interesting is if you look at what is happening with TCS, and there you should be looking at a longer-term chart, and what you have now on the screen is monthly chart of TCS Limited. The top that we see here, it happened in 2015, or rather 2014. And since then, this stock has been moving in a range. You can see a clear channel that one can draw from the the range that we had seen in this stock. What is important to note here, though, in November, we did make an attempt to cross this and give a breakout, but it failed, and the stock came back into the range and consolidated for a few more weeks before we saw a decisive breakout once again last month, and we have been sustaining it. The green line here, the dotted line that you can see at the top, is actually the all-time high that was hit in 2014, and we are very close to that level now. I think it is placed at around 28.40.45. That has been the all-time high on TCS, and looks like, given the momentum, we'll probably hit that level and most probably surpass that level as well. So looks like there is a breakout in TCS as well, that too on a longer term chart, which means probably TCS is also moving to a new range and getting out of a consolidation that lasted for several quarters, or rather years, so to say. Jay, if you look at both these charts, or whichever way you want to look at both these stocks, what's your comment?
Yeah, let me first make a larger point. 13 months ago, when I had given an interaction for Bloomberg Quint Print, when the Nifty was about 7,900, I said IT was the contrarian bet, and I had projected a price objective of about 13,000 for the IT index, and I said the main frontliners will be the laggards, it will be the mid-cap IT which will be the outperformers, and here we are with Infosys, TCS, HCL Tech, Wipro struggling, and if you look at Tata LXC or an Oracle Financials or a Hexaware or a Polaris, they've all doubled. Now, that being the case, coming to the short term, I still see the frontline indices, frontline IT names like TCS or Infosys not doing too much well. But even if they were to do too well, I think it will be the mid caps which will be still outperforming the frontline names. So let's talk about price projections. I think the chances of TCS breaking out past the 2850 record highs is much higher than Infosys going to record highs. So if even if they were to go, if 2850 is broken for TCS, I expect a price level somewhere close to a maximum of 3200. forward, not beyond that. When it comes to Infosys, I think it's got some serious resistance around 1100, 1150. So, I'm not too gung-ho about the frontline IT names. It'll still be the mid-cap IT names for me.
Say, speaking about mid-cap IT, I thought I'll put in an effort. I just preempted that all of us will be talking about mid-cap IT, and lo and behold, I'm putting the spotlight on one of the mid-cap IT names. Now, before I do that, look at some of the mid-cap IT names and the returns thereof. So I've chosen 4 stocks: Nucleus Software, Sonata Software, which is incidentally up about 9-10% today, Mindtree, and Persistent Systems. And if you look at the last 1 year chart, all of them have of course started from the same point. These are the returns charts of each of these stocks. You will see that while all of them were in a cluster, I think post October, all the other 3 names that I spoke about have had a good move upwards. There is Mindtree out here in the white line, and there is Nucleus Software and Sonata Software, and look at the gains there. And then lying at the bottom is Persistent Systems. It's gained much lower compared to any of the other mid-cap IT names. Now, the reason why I'm putting the spotlight on Persistent is because Credit Suisse came out with a note today on Persistent Systems. They expect a strong earnings revival for the company over FY18 to FY20. They believe that the margins picture will improve, expand by about 200 basis points, again over the same time frame. And the valuations at about 13 times FY20 are fairly reasonable. And look at what it's done to the stock. By the way, so if you bring up the GD of Persistent Systems, you will see that the volumes have significantly expanded. There are a lot of buy calls despite the fact that the consensus target price is lower than the current market price. But it's a stock that trades at a discount to its peers, and it's now starting to find favor, as you can see by the note that Credit Suisse has put out, or some of the other brokerage houses are talking about as well. Nipun, any thoughts on Persistent Systems individually? For long, a lot of people admire the management, but the stock is not able to deliver the returns that people would want from it.
Well, Neeraj, we don't track the stock, but I think mid-cap IT, clearly, when you look at it on a selective basis, has really outperformed. And there are several examples that one can look at over the last 2 or 3 years when there has been an underperformance from the large cap. I think several reasons, at least some of them have been able to take far greater benefit of the newer opportunities that have come by. Secondly, I think some of them also have focused on the domestic market, which some of the large cap companies or the largest sized companies haven't been able to take the same kind of benefit. Again, they've really seen better utilization of their cash on the balance sheet that is there. So I think the growth one has seen for the mid-sized IT companies clearly has been far superior. And there are several examples of Mindtree, eClerx. One can really look at least 8 or 10 such examples where there has been that outperformance. And I think that's something that should continue as long as this kind of higher growth is something that they continue to see over the next few quarters.
Well, besides IT, what else is doing well? Pull up the Nifty Realty Index. I guess it's come off day's high right now, but it's still holding with gains of about over 1%. And remember, this is the index which outperformed in 2017 as well. The run-up to 2018 so far has been pretty good, and its constituents like Oberoi, India Bulls Real Estate have been doing pretty well. Let's just pull up Oberoi Realty. DLF2 has been hitting fresh 52-week high, but I guess today is the day for DLF when there is a bit of profit booking which has been seen, and I guess the stock is off day's high. Sumeet, let me come to you on the charts. Any of these stocks, Godrej Properties, Oberoi Realty, or for that matter DLF from the Realty pack, which one looks like a good bet?
Well, realty sector itself is looking good to me. All these stocks have given a very good move in last couple of days, and now immediately looking at the chart, it seems that Godrej Property and Oberoi, both these stocks are looking very good, and from here on there is a possibility that we might see extended move in which Godrej Property has potential to touch levels of around 900 as an immediate target. And if we talk of a slightly longer term time horizon, then there is a possibility that we might see levels of around 1000 also in Godrej Properties. If there is any dip of around 40 to 50 points from present levels in Godrej Property, then that should be used as a buying opportunity. I think dips in prices till 790, 800 levels in Godrej property should be used as buying opportunity, and on higher side 900 can be the immediate targets. If 900 is taken away convincingly, then we can see extended move till 1000 levels in next couple of months. At the same time, Oberoi Realty is looking good on charts. I think the stock has given a good move in last couple of months. At present levels, the stock is looking good for the upside target of 600 and 650 levels. One can initiate long positions in Oberoi Realty too. Those who have taken positions at lower levels, they can hold on the existing long positions with the trailing stop loss to be placed at around 520 levels on lower side, and on higher side immediately the stock is headed for 600 levels. If 600 is taken away convincingly, then we can see extended move till 650 levels. So overall, for the upside move of 15 to 20%, one can initiate long positions at the current market price.
Okay, so that's the call on real estate stocks. And before we talk about some of the banking names and take an update there, just let me mark a few stocks. GTPL Hathway has gone up by around 5%. That's a upswing in last few minutes of trade that you can see. The stock is quoting a day's high, up by around 12% now. Eros International is the second one, which has gained around 1.5%. Ador Welding would also be one such stock that has climbed sharply over last few minutes. But let's move on. Reports suggest that IDFC Bank is in talks to join hands with Capital First. The bank was also in talks with the Shriram Group earlier, which fell apart in October. What is the rationale behind this? Shraddha Babla is standing by with more details. Shraddha.
To start off with, I just want to mention that even when the merger talks of IDFC Group fell off with the Shriram Group, they had mentioned back then in October that they would continue to look for inorganic opportunities. Now, when IDFC Bank was launched in 2015, the strategy was to become a mass retail bank in the next 5 years, but currently the CASA ratio of the bank stands at just about 8.2%, probably the lowest in the banking industry. So the broad retail and the SME customer base of Capital First actually make it a perfect candidate for a merger as far as IDFC Bank is concerned, and fits well into its strategy. Now, even when you look at the loan books of both these companies, IDFC has a very wholesale-oriented loan book, while Capital First is 93% retail. So it complements IDFC's loan book perfectly well. Additionally, Capital First also offers a profitable model, so which is demonstrated by the 5-year CAGR growth in AUM and PAT of 27% and 40%. Capital First loan balance sheet has also been relatively healthy, with a gross NPA ratio of about 1 to 1.5% in the last 5 years. Now, if you look at it from the Capital First perspective, it has previously not spoken about banking aspirations in public, but a potential merger with IDFC Bank would mean that it will be able to access low-cost funds. But again, a merger will mean that they will have to set aside funds for meeting RBI's SLR and CRR requirements. Broadly, what could this merger be dependent on? One is what the large shareholders have to believe. Remember, Warburg Pincus holds about 36% stake in Capital First. Secondly, RBI's restrictions on shareholding in private banks is also something that will have to be that will also have a role to play. And thirdly, valuations. Now, if you look at the return ratios, those for Capital First are significantly higher than those of IDFC Bank. And again, even if you look at the valuations, the FY19 price to book of Capital First is double at 2.6 times as compared to IDFC Bank's 1.3. So all of these will have a role to play, but broadly it seems a better fit at least than the Shriram Group merger.
A standard disclaimer out here, I'm sure that Shraddha would put out, and we are saying out as well. This is not something that Bloomberg Quint has knowledge of. It is something that has been reported. We are just merely presenting a scenario analysis, if I'm not wrong. Shraddha, thanks for putting that into perspective. So if this were to happen, it's probably a better fit for IDFC Bank than the previous attempts have been. 7.5% for IDFC Bank. Capital First too has got far. 3.5% today after that big movement trade yesterday. Nipun, have you looked at these names? And what all IDFC has been trying to do, right? I mean, the Shriram Group earlier, that didn't succeed. Now the talk of maybe Capital First. What are your thoughts here?
Well, I think one thing that clearly stands out in all of these rumors or efforts that are being put in this kind of consolidation is the fact that IDFC Bank hasn't really been able to take off ever since its demerger from IDFC itself. Probably what has the positive that I see in terms of as and when or the last 2 years or 3 years of journey that we've seen for the bank is the fact that rather than opening up too many branches, I think they've gone the digitization way. And that's something that has ensured that costs are not extremely high. I think with any merger, and efforts obviously in the last 1 year seem to be clearly on the roadmap, that there has to be an NBFC which has a retail spread across different verticals in as an NBFC, and which the bank can really take benefit of in terms of any potential merger that is there. I think any merger with any of these NBFCs which have a fairly large spread is something that's going to benefit both the entities. What I'm surprised about is, despite us going through a downtick in a lot of these industries, let's say the banking industry, the real estate industry, the infrastructure industry, we haven't seen the kind of pace of consolidation that typically the industry undergoes when this kind of challenging times do come about, and in certain cases balance sheets are stretched. You've seen that in across the PSU banking space. You've really not seen any major consolidation over the last 2 or 3 years, except maybe whatever the SBI consolidation was about, not necessarily balance sheet related. But I think the entire space, whether it is banking or real estate that you were talking about earlier, and or infrastructure, and some of these verticals or industry
right,
which has seen challenges, need to go through a lot more consolidation.
Okay. Okay, Nipun, afraid we'll have to leave it at that because we need to hit that break before the next segment starts. But appreciate you taking the time out and joining us today. Thanks much for being with us today. Take a very quick break. Come back on the other side of Countdown. We start off with the Fab 4 stocks of the day. At 3:15, we tell you what daily nooms are recommending in the session, and of course, also tell you about what stocks will go into the FNO ban or come out of the FNO ban.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Business news, we're news for business people.
Welcome back. You're watching Countdown with us. Well, remember today is the day when the Bank Nifty weekly options contract expire, and hence the reason we've seen a bit of volatility in the last half an hour of trade. The Bank Nifty's off day's high, currently trading very comfortably though above the mark of 25,600. If you look at the options data, it looks like the expiry will happen in the range of 25,550 to about 700. But let's see where the actual expiry takes place. That's about the index. But let's also speak about the Fab 4 stocks of the day, and to take us through the same as usual, Yash Upadhyay joins us. Hi Yash.
Good afternoon, Navneet. So we have Himadri Specialty Chemicals, which is at the top of our Fab 4 list. The stock is up as much as 4.5–5% today after we saw Axis Securities come out with a note initiating coverage on it. Now they have assigned a buy rating and have set a target price of 238 rupees, which indicates an upside potential of almost 28% from its previous day's close. This is over and above the 5x move that the stock price saw in 2017, making it one of the top multi-baggers. Also, they believe that the company's carbon black product segment to be the key driver of earnings going forward, and expect their revenues and net profit to grow at a compounded annual growth rate of 23% and 58% over FY17 to FY20. Big moves coming in from Cochin Shipyard as well, after the company said that it has signed a memorandum of understanding with Mumbai Port Trust for the maintenance and operation of its ship repair facilities, and the stock is up about 4.5% as well. Fresh 52-week highs for GE Power after the stock had gained almost 9% today, but has clearly come off from those highs and is sitting at gains about 2.5–3% after the company said that it has won an order worth close to 820 crore rupees for the supply of 80 megawatts capacity of turbine generators. And finally, we have Symphony India. The stock is up almost 6%, making it the top gainer on the BSE Consumer Durables Index after the latest December shareholding pattern suggests that HDFC Mutual Fund has bought in close to 8.5 lakh shares or 1.2% equity in the company. Back to you.
Interesting. Many thanks for that, Yash. So those are some fairly interesting names. Jay, do you track any of these? There was Symphony, there was Himadri Chemicals amongst a couple of names that we spoke about.
Yeah, see, I've been looking at Symphony for quite some time now, but I think it's heading to an important peak. Be careful in this counter. I think it's going to have at least a short-term pullback. This is not the time to put money in that counter. And in the Fab 4 section, we spoke about specialty chemicals. If you recall, 3 weeks back, I said something's going to happen in the specialty sector. And in the last 1 week, they've been in the buzz, and it's been getting a lot of media attention. And we spoke about specialty chemicals called Daiichi Kirkray when it was trading at about 348. Now today it's about 480–490. I just want to make an important point here. And I said I've been talking about crude going up all through November and December, and here we are Brent at 69. And I just want to make a point that Daiichi Kirkray is actually in specialty chemicals related to crude. So this stock, watch out for this. As I pointed out last time, there's no brokerage coverage here, and the stock is just warming up, and crude has got tremendous amount of steam left. As I pointed out in November and December, it'll at least do $80 to $85. So watch out for this. This is going to do extremely well.
Does it continue to be a buy call, or is it a hold now, Daiichi?
Oh, definitely. From 4, I am expected to do a bad minimum of 650 to 700. But if crude were to go to 85 to 90, we can't say where this stock will go. So a bad minimum price objective is 650. It continues to buy, but be aware this is an illiquid counter. So the risks are a bit elevated. We are at 348. The risks were much lower. Now it's come to 480. So you should understand your risk at this point of time.
It's interesting. I was intrigued that Jay used the term, the stock is just warming up, after the stock has already moved up from whatever levels that Jay first recommended it all the way to,
I think it's almost 80 rupees. Or
80 or 100 odd rupees. So that's very interesting. But Daiichi Kirkray, 481. Fantastic calling out there, Jay. Yeah, the other interesting one is, of course, ICICI Pru. And the reason I say it's interesting, his call today, is because if you look at the last 3 months for ICICI Pru versus an HDFC Standard Life, because they are comparables and because they're in the same industry, just look at the last 3-month chart of ICICI Prudential. Flat, almost nothing. In fact, for the last 6 months, I presume it's done nothing. HDFC has about a 24% gain as well. So the others have actually gained. ICICI hasn't. Let's see if it does play a bit of a catch-up. Over the 6 months too, HDFC Life would have done 10%. I'm just listed really. But ICICI Prudential has actually corrected from the levels that it was at. So let's wait and watch if there's a bit of a change here.
Yeah, and an interesting turnaround maybe. Mayuresh Joshi, fund manager at Angel Broking, is joining us now. Another stock that Yash actually talked about, was Cochin Shipyard. The tie-up that they have got into with Mumbai Port Trust is one, but the other big news which has hurt another PSU, that is Dredging Corporation, is a proposal from shipping industry that a Cochin Shipyard or any other big shipyard could be merged with Dredging Corporation instead of privatizing dredging. That is the proposal which is under consideration right now. Mayuresh, in that case, what would be the impact? Suppose Cochin Shipyard and dredging were getting merged. What happens to both these, the shareholders of both these?
So largely, again, I think, Pradeep, the element of doubt in terms of how the merger processes will land up is very, very speculative at this point of time. But largely, if you look at the payoffs that each of these individual companies did present, and we did speak about this dredging, again, I think the revenue prospects look extremely encouraging in terms of what the government reform processes are related to inland waterways, and again, the kind of order book that it already has. But to a large bit, again, valuations not supportive. For Cochin, on the other hand, if you look at the order book, extremely robust order book giving very strong revenue visibility. If you look at ROEs, ROCs, well in excess of 15.5%. The working capital position is extremely good at around 58 or 59 odd days for FY17. And the operating margin is equally impressive at around 18.5, 19 odd percent. So they recorded EPS of around 28-29 for FY17. They're going to compound that because the ship repair business, which is 26% of their overall top line, and the cash that they've got on their books and the strong accruals that they probably get through their core business of ship repairs as well as shipbuilding, I think that should augur well for the stock. So between the two, again, I think very speculative in terms of whether the merger will happen or it will not happen. But individual balance sheets, Cochin Shipyard is something that I'll still continue to prefer. Even though from a valuation perspective, it might be a little bit expensive, but that premium will always be attached to the stock considering its strong dynamics on the financial front that it can exhibit.
Okay, so actually what Mayuresh has said is very important, that Cochin Shipyard is moving up on its own fundamental merits, but Dredging Corporation has gone up just on the expectation that it will get privatized. So there is a premium here over and above the fundamental value of Dredging Corporation. Jay, before we let you go, one last call on Dredging Corp. Several investors and traders have got into Dredging Corp in expectation of a privatization. Where would you like to put a stop loss, or what would be your advice to them now?
Yeah, 539 is a very important support from a medium to long-term perspective. But from the perspective of chart, I think their speculation might get just rewarded. It does just look like it's going to take out the record highs past 1400. I don't know. I could be wrong, but you have your stops, you have your supports. But at this point of time, the risks are elevated. But from current levels about 850 to 870 odds to 539 is quite wide. So this is not the entry point for you. But if you already speculated on this, just hold on to it with a stop loss of about 539.
Thanks, Jay. Thanks a lot for joining us today. But Neeraj, that is very interesting. What Jay thinks, that actually the charts are telling him that privatization will happen. So people who have gotten the kind of pattern that has created, the kind of price and volume movement that we have seen, suggests that there is very strong conviction in these buyers.
So many times I've heard this, right? Charts talk about events. Let's wait and watch if this happens here or not.
As long as there is informed buying, charts will tell you what's going to happen.
Okay, anyways, Jay, thanks so much for joining in today and giving us your perspective. Now, before we move any further and taking some other thoughts from both our guests, which is Mayuresh as well as Sumeet, it's 3:10, or actually a minute over. But let's ask Navneet, what are the stocks that are likely to enter into the F&O ban or come out of the F&O ban?
I've got three stocks in my list, and all three are doing very well today. So let me start off with the one which may enter into the F&O ban tomorrow. Remember, Jindal Steel and Power came out of the F&O ban, and that's likely to enter once again. That's the list of the stocks which may come out of the F&O ban. Let's start off with Jindal Steel and Power, which may enter. Well, yesterday when it came out, the total open interest was nearly 79%. For a stock, it has to breach the 95% mark, and there has been huge amount of build-up which has come in for Jindal Steel and Power futures. If you could just pull up that's going to tell you exactly what's the uptick for the open interest there, 21% higher, and a lot of the option strikes are also pretty active. So if you club the open interest addition, it looks like it may breach the 95% mark. And I just want to remind the stocks also trading at its fresh 52-week high. Two stocks which can come out, IFCI, which is doing pretty well today. Even Jain Irrigation has seen substantial gains. The underlying is up almost 3.5 to 4%. That is the counter which is hit fresh 52-week high in today's session, and yesterday's open interest was 80 to 81% for both these stocks. It has to breach the mark of 80, which looks very likely because we've seen unwinding for the January futures of both these stocks and also a couple of their option strikes. So watch out for all these three counters which have seen gains of between 4 to 5% today.
Okay, so watch out for all of these names. Keep an eye out for JSPL in particular as well. A couple of other stocks that have just shot up in just the recent few minutes. One of them is Capital First, was anyways doing well and I think is inched up further. So bring up that stock, the intraday of Capital First, and look at that, 5.5% now, 835. In 3 days, Capital First has gained close to 120 odd rupees. That's a strong move there. The other one is Oberoi Realty, certainly shooting up in trade. Look at Oberoi Realty to 5.5%, 556 and counting. It's after a while that we're seeing the big boy make a move, Mayuresh. A lot of talk about how some of the mid-sized real estate names have done well. Now it's time to talk about, the men who matter. Oberoi Realty, what are your thoughts here?
So very strong prospects, Neeraj. Again, I think with the changes that we are hearing in terms of the proposed FDR norms, we're probably going to see greater traction happening for developers based out of Mumbai. So in that respect, again, the kind of land magnet it has got, the kind of launches that it had initiated a few quarters back, the kind of response that it has got. And again, I think comparably, I think the balance sheet dynamics are a lot more stronger than a few players where the leverage probably still remains extremely high. So yes, I think with the new norms, if they're expected to come through, this along with Godrej Properties can be clear beneficiaries.
Watch out for this one. Sumeet, any thoughts here? Godrej Properties as a trade? Rather, Oberoi Realty as a trade?
Yes, as I already said, that Oberoi Realty is looking very good on charts. In fact, realty stocks like Godrej and Oberoi are looking good on charts. As far as question on Oberoi Realty is concerned, we are expecting a move around 15 to 20%. Stock has given a good move in the last couple of days. But still, it does not look like that the stock is overbought. In fact, it's looking like that there is a possibility that from here on we can see a move till 600 levels as an immediate target. And if 600 is taken away, then we can see a move till 650 levels also. I think those who have taken positions at lower levels, they can hold on the existing long positions. And if anyone wants, they can initiate fresh long positions also for the upside target of 600 levels in next couple of days.
Okay, let's wait and watch what happens here. For now though, it's 3:15, that time of the show when we tell you what dealing rooms are recommending in the session today. And Darshan and Yatin join in with their channel checks. Good afternoon, both of you. Yatin, let's start off with you first.
Neeraj, a couple of stocks to talk about, and if you look at Bharti Infratel, that is one stock, and based on F&O trends, dealers are recommending a sell today, buy tomorrow kind of a strategy. So STBT, as far as Bharti Infratel is concerned, marginally lower in trade today. Also watch out for CSC, that stock is showing some traction in the last 3-4 days. Also we have seen good volumes in the stock. So on an overall basis, that is one stock wherein domestic funds are accumulating shares. And watch out for Aditya Birla Capital. That stock has been marginally higher today, but on decent volumes, almost 45-46 lakh shares traded as far as this counter is concerned, and dealers indicate that HNIs have been accumulating the stock, and for the short term they are quite bullish as far as this stock is concerned. But Darshan has a couple of other stocks.
Yeah, so GSFC is up almost 5%. Some of the product that it sells prices have gone up significantly. Caprolactam prices have gone up significantly as crude is also moving up. So one of the key products, and it's a cyclical business. So GSFC is one of the counters dealers are talking about. Gujarat Ambuja, it processes maize and basically it caters a lot to the animal food processing business. A domestic brokerage is actively pushing this counter to its clients. So GSFC is, Gujarat Ambuja is up almost 15% in trade. And Jain Irrigation, again, traction continues. It's been a very, very strong mover, and HNIs are accumulating. The pending demerger of the foods business is the play that HNIs are indicating why they are liking Jain Irrigation at this point of time. The management has been open indicating that the IPO, first the demerger of the food business and the IPO will happen. When that will happen, no one knows, but there seems to be a lot of traction, and HNIs accumulating based on that story.
Interesting. Thanks a lot for that, Darshan. Jain Irrigation among stocks. CESC is the other interesting one. Remember, the whole demerger and the value accretion to a shareholder who's holding CESC, and that's been around for a really long time. The stock's made some serious moves the last 6 odd months. Mayuresh, any coverage here? CESC?
We did discuss this, Neeraj, I think only a couple of weeks back or 3 weeks back, and I'm extremely positive on this stock because if you look at the sum of total parts for all their businesses combined together, each of their business units is expected to do well. So if you talk about the generation business, again, largely when you're talking about return ratios, you're talking about the IRRs that are expected from this business, I think they're extremely strong. The ROEs remain extremely strong at 17.5%. When you're talking about the transmission part of their business, again, very strong IRRs. You're probably looking at a negative working capital cycle working here, and ROEs again remaining extremely robust at 17.5–18%. On the Spencer's business, again, the EBITDA performance has been extremely encouraging, and the management is very, very hopeful of probably delivering something on the bottom line over the next few quarters. And the other businesses are contributing their fair bit. So to a large extent, if you sum across all the businesses together and value ascribing each of these businesses individually, I think there is significant potential still left in my opinion. So yes, I think I have remained positive on the stock, remain positive going ahead as well.
Okay, so positive view on CSA coming in from Rajesh. We are getting into last 10 minutes of trade now. Sumeet, if you had to recommend one or two STBT or BTST ideas, what would those be?
BTST calls. I have BTST calls. The first one is IDFC. IDFC is looking good, and after a long time, it seems that the stock has been giving good moves in last couple of days. And looking at the chart, it seems that the same move can continue. Today we have seen the volume and price action in IDFC, which says that the stock is headed higher, and from here on we can see a move in the counter till 70 levels. So I think one can initiate long positions in IDFC at CMP, that is at around 66 levels, with a small stop loss to be placed at around 64 levels on lower side for the upside target of 70. And if 70 is taken away, then there is a possibility that we might see extended move till 72 levels also. And the second stock for the day is Sun TV. Sun TV is looking good on charts. It seems that from here on, upside move can be seen, in which on higher side we can see levels of around 1080 and 1100 as a target. So for a trading perspective, one can initiate long positions in Sun TV at CMP with a small stop loss to be placed at around 1030 levels on lower side for the upside target of 1080 and 1100 levels in next 1 or 2 days.
Let's just pull up the intraday chart of IndusInd Bank. Remember, the bank declared its numbers a while back. The numbers were fine. It's just that a mild bit of disappointment was seen with regard to asset quality. And look at that. It's recovered from days low, but it's still trading with cuts of nearly 2%. And the impact has been seen for Bharat Financial as well. If you could just pull up, remember there were talks of merger where both the parties have confirmed that now. Let's just pull up that. So that impact has been seen for Bharat Financial after IndusInd's numbers, because after the numbers you did see a bit of correction for IndusInd Bank, and now Bharat Financial too has corrected. That's trading with cuts of over 2%. Mayuresh, what did you make of the numbers of IndusInd Bank? Do you see any sort of dip with a stock like this can be used as a buying opportunity?
Yes, I think the probability remains high, Navneet, on this front, because I think the numbers were more or less in line with expectations. I think a marginal dip to say in terms of expectations on how NII growth was supposed to fare. But again, I think asset quality largely has held out, though you've seen a small uptick in terms of the reported GNPs. I think that was very well expected. But again, I think CASA accretion has been good. You're probably looking at disbursements, specifically in the vehicle finance section, being extremely robust. Their credit card business, diamond business doing extremely well as well. So yes, large part of the element in terms of earnings growth on the base that it has been delivering over the last few quarters has been maintained. The premium in terms of valuations on a price to book parameter, which stays above 4, has always been the case. But again, I think it is good precision numbers that this bank has delivered. So yes, I think any dip probably becomes a good opportunity in a staggered way for long-term investors to look at the stock.
This is actually interesting. If you look at what has happened over the last 1 week or so, IndusInd Bank had actually gone up, and it happens very often, Navneet, with this bank, because it's so predictable. 25% kind of a growth that it shows, that it's most of the time before numbers it is already priced in, and we see a run up to the result, then a cool off, and then the next leg up, we should probably take it much higher. So that could be a strategy, to play, that you wait for a while and see where it stabilizes and then get in. Another segment which is doing well today is kind of media, entertainment, rather distribution companies. You have Eros doing well, GTPL Hathway is the other stock that I see moving up. In this segment, Sumeet, have you spotted any interesting chart pattern, any stock that you would like to recommend? Even then, I think is moving up.
Yeah, Den is moving up. The stock has been consolidating in last couple of days, and from here on there is a possibility that we might see a move, because we have seen a volume-based move today, which says that from here on a good move can be seen. So for a trading perspective, yes, one can initiate long positions in then at CMP for the upside target of 8 to 10% in next couple of days. And overall, for a longer term time horizon also, I think the stock is looking good. And after a long time, after a couple of years, the stock has made bottom, and from lower levels, it has started moving up. The chart says that the stock is headed higher, and from here on, there is a possibility that in next couple of months, we can see a move till 140, 150 levels. That would be targets for next 4 to 6 months time horizon. But purely for a trading perspective, we can see a move around 8 to 10% in next couple of days, or probably next 1 or 2 weeks.
Look at Delta Corp ahead of its numbers on Monday. That stock is up 5%. I think this is nudging its, or very close to its all-time high levels. So Delta Corp has certainly done very well. And divergent moves in GMR and GVK. GMR Infra is down in the session today, but GVK Power continues to rise and shine. So this one is down 3%. GVK Power is up about 5%. But I thought Delta Corp was a very interesting mover in the session today. Any coverage here, Mayuresh? Delta Corp, and frankly, a lot of stocks have done this, but from those demonetization lows, wherein it was believed that the business model would get completely altered, I think it's made a really strong comeback. 110 was the level at which it had fallen to. Currently at 318. That's a remarkable pullback for Delta Corp in the last 1 year.
No official coverage, but yes, I think a remarkable pullback, Neeraj, and all the woes that you probably had witnessed post demonetization. Again, a large element in terms of new properties coming up is something that is keeping the stock afloat. But the numbers will be very, very interesting. So I'll be watching out for numbers, but no coverage. That's why I'll not be able to comment on the stock.
Well, a couple of these auto ands are doing well. Pull up Setco Automotive, that's just surged in the last, I guess, 5 to 10 minutes of trade. And if I remember, Jamna Auto was also doing well in today's trading session. GNA Axles has seen gains of almost, I guess, 1% or 1.5%. Jamna Auto, however, its off day is high, but still sitting with gains of almost 2.5%. Mayuresh, anything in this space? Auto ands, there are a lot of multi-baggers, so to say, of 2017 from this space. Would you bet on anything?
So Navneet, again, a large element for auto angs has been the performance on how the OEMs or the replacement markets will fare. So to that bit, my own sense is Endurance Technologies is something that we had liked. I continue to like that, both on the premise of strong operating cash flows actually aiding their business. The four-wheeler or the aluminium casting business in Europe is expected to do extremely well. The marquee clients that it has got in the two-wheeler segment and the growth that one really expects, both from the OEM side as well as the replacement market, can be phenomenal in terms of them maintaining their margins above 14.5%. So Endurance Technologies on the auto ank is something that I'll continue to like. And from the bearing space, I think fact bearings is something that I'll still continue to prefer on declines. The merger that they've done with their associate companies, I think though the blended margins might come down a tad bit, I think the wide exposure that they get to the industrial and the automotive bearing segment is going to be pretty large. The cost synergy is obviously going to get into the balance sheet over the next few quarters, and that's going to abet their earnings growth in a significant way. So I think fact bearings is also something that I'll continue to prefer on declines.
Okay, so that's the view on the auto ancillary space. Well, the markets are about to close, and let's head across to Pradeep to find out how exactly the closing is panning out today. Pradeep?
So market, so far as Nifty and Sensex is concerned, it remained in a very, very tight range and closing somewhere at the upper end of that range, 10,655 odd levels on Nifty. Nifty Bank thankfully stayed strong today, and it has also once again moved above 25,650 odd levels. That technically is very significant. Look at small cap and mid cap space. There also we have seen positive trend. Most part of the day, both the indices remained on the positive side, and in fact closing with gains of almost 1/3 to 0.5%, both the mid cap and small cap indices that you could see. Let's see what's happening with the index. Overall, the market breadth among the Sensex stocks is probably more like 55-45, but there are key gainers, heavyweights like Infosys, Bharti, Kotak Mahindra, HDFC, HUL, HDFC Bank that have been pulling the index up. So banking has done well, especially private sector banking. That was the key driver in today's trade. On the negative side, Also, we have IndusInd Bank, though, that reacted to the numbers, and ICICI Bank and Axis Bank also figure among key losers. That's interesting. Wipro is the other key loser, while Infosys is the top gainer. So that's the divergent trend we have seen. TCS has also cooled off a bit ahead of numbers.
I think we're going to close above the 10,650 mark, so that's another positive takeaway from today's session. But from the broader markets, there were a lot of stock-specific moves that we saw. The first up is JVL Agro. That stock was locked in upper circuit with gains of nearly 20% today, and we did speak to the management where they highlighted that the second half of this fiscal is looking better with them. They're focusing on higher margin businesses. For example, they've entered into basmati rice and also pulses, so watch out for that counter. Gujarat Ambuja Exports is the other one, which did pretty well in today's session. As you can see the graph there on your screen, substantial gains seen for this counter as well. Good Luck India is the other one, which was once again up in today's trading session. Good Luck India saw almost close around the day's high levels, and well, IDFC Bank and Capital First, clearly these two stocks were in focus today after reports suggested that both of them are exploring some merger opportunities. And remember, both these stocks are also in the futures and options market, but what we saw today was more of the activity seen on the cash side, and if you check the delivery data, it's been little higher if you compare it to the previous sessions as well. So watch out for these two stocks. And IFCI, another one from the futures and options market, that was up nearly 6% in today's session, and GSFC is the other one which was active today. Good amount of long positions was seen actually in this counter, closing almost at day's high. Bajaj Corp came out with its numbers, healthy set of numbers. The stock registered its fresh 52-week high. Also, Macquarie initiating an outperform rating on this counter. Container Corp, which was up yesterday, saw some bit of profit booking today, and the laggard in the futures and options market, Fortis Healthcare, that stock saw cuts of nearly 8% coming about, and Dredging Corp saw cuts coming after Shipping Ministry highlighted that they will explore opportunities to privatize the company. Neeraj.
Well, and this is how the market is looking at close. Flat as flat can be. I think the broader markets too haven't really outperformed in a meaningful way. Mid caps and the small caps will come up on your screen, but from the last that I remember, not really a dramatic. Let's get up the indices, the BSE mid cap or the BSE small cap indices, and I don't think there is a dramatic move there. No, there isn't. And I think the heat map also showed that it's even Stevens. Navneet, interestingly, I'm surprised. I mean, it'd be surprised if the volumes come off dramatically, because the options volume should anyways be high, but an eye out also for the cash volumes and to see if they indeed match the 36,000 number.
Sure, it's been consistently around that range of 35, 36, so above the average I would call it, but it's been in that range of near 35 to 37. And as you mentioned, the F&O volumes of NSE are high because of Bank Nifty's weekly options contract. Even the BSE cash has been, in that range.
In a higher range now.
Yeah, 4.5. Usually you see 3.5 to 4,000 crore of turnover. So I don't know if this is cash-based buying, which one is seeing. More activity is actually being seen on the cash side of the market.
No, and the last 3 days, for example, the buying in the IT stocks has been dramatic. The delivery percentages have been very, very strong. The volumes have been high too. So that's one aspect. If we can just get the contributors list for a moment before we get back to our guests, the contributors list will show you not enough participation by Reliance, and IT, remember, has divergent trends today, which is why you see TCS here. But Infosys, Tech Mahindra is not on this list because it's not a heavyweight, but Infosys certainly up there. But as you can see, financials in a little bit participate, at least the private financials did. But on the flip side, you had the two names, IndusInd with results and ICICI Bank as well. So even Stevens on IT, even Stevens on technology as well, and which is why a very lull kind of a session, more activity in the mid cap end of the market as compared to the large cap end of the market. Anyways, the results, one set of results has come out today. I think we are waiting. We got Bajaj Corp. We are waiting Shree Cement, if I'm not wrong.
Shree Cement and TCS.
Shree Cement and TCS, which is ready to come out any moment. Mayuresh, we've spoken IT enough. Any thoughts on Shree Cement and what to expect thereof?
One can expect a reasonable amount of volume growth, around 6 to 7 odd percent. So what they posted of 4.88 million tons in the quarter gone by, it should be close to around 5.10, 5.15, within that range. The realization should be quite reasonable as well. The cost effect will eat into their EBIT margins and the EBIT per ton that they'll probably report. And a large element of their power business, because merchant power rates are actually down. I think the merchant EBIT or the power EBIT is expected to be rather low, both on a quarter-on-quarter basis and a year-on-year basis From a pure valuation perspective, again on an EV to ton basis, I think it trades around $215 per ton. But a large element in terms of the coke costs, which have gone up significantly, will eat into the margins. But the return on invested capital, with the efficiencies that they're building capacities, and as these capacities come on stream and they run at a very reasonable utilization level, the leverage can absolutely play on their balance sheet. So the whole rating absolutely continues, or HT Cement, from our perspective.
Whole rating continues here, but it's important to note today that both the indices, Sensex and Nifty, have closed at the highest closing level. So these are new record close for Sensex above 34,500 and for Nifty above 10,650. Sumeet, what does that tell you? What would be your strategy on the index?
Well, closing is very strong. Closing says that there is buying momentum and markets are headed higher. As I said earlier, we're expecting Nifty to touch 10,700 levels in next 1 or 2 days. So till the time 10,600 levels are not taken away, one should be on buy side for the targets of 10,700 level as an immediate target. And a closing about 10,700 will take index towards 11,000 levels in next couple of weeks. So overall, markets are very strong. If by chance, because of volatility, if there is any correction, then that should be used as a buying opportunity. For an immediate trade, I think for next 1 or 2 days, one can be on buy side for the targets of 10,700 levels in Nifty. And as far as Bank Nifty is concerned, from here on, about 25,700 levels, we will see Bank Nifty moving towards 25,900 and 26,000 levels. So both the indexes are looking strong to me. I think one should be on buy side for next couple of days.
Okay, thanks a lot, Mayuresh, as well as Sumeet, for joining us today and taking us through your views on the markets. Well, on that note, we'll slip into a short break on this edition of Countdown. Don't go anywhere. We'll be back with more on the other side.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Welcome back. You're still watching Countdown with us. Well, this is a good time to start allocating in pharma. That's the word coming in from Swaroop Mohanty, the Chief Executive Officer at Mirae Asset Global Investment. India, well, in the chat with Bloomberg Quint's Jayesh Khilnani, he further talks about the investment themes for the year, expectations from the Union Budget 2018, and much more. Here's an excerpt of that conversation.
We feel that pharma today is no longer just pharma. It is tending towards a broader spectrum of healthcare. And if you look at that broad spectrum of healthcare, it is looking fairly diversified from pharma companies to insurance companies. You can make a good portfolio out of that. Yes, it's a great time to start allocating to that, and then you can build great positions in that. For all you know, in the next 6-8 months, we might think of coming out with a fund in that category. Yes, we're quite comfortable with that segment.
Okay. Let's talk something more, closer to your industry on the mutual fund aspect. Now, there was a recent circular for consolidation of the schemes, and your house has only 8 schemes that are running. So, what's your thought process on that?
See, we always believed that this was a business of simplicity and conviction. And you show conviction when your scheme stands consistently over a period of time. We've restrained ourselves from coming and giving me to improved same fund in the market time and again to gather assets. That's not how it should have been done. And I'm very happy that the regulator now consolidates the schemes and it makes it so simple for everybody in the market. It's great for the funds because they will have only that many schemes to focus on. So it will improve fund management. It's great for the investor because he knows what the categories are. It will be brilliant for the advisors because now when everybody is put on the same platform, it's good to compare each other from that and the best fund will win, obviously. So it's something which we've been following since inception. It's been 10 years of us being one fund per category, and I'm happy to see that the industry is aligning to that.
Great. Let's talk about another recent circular which asks you all to measure the scheme performance versus the total return index. So do you foresee any challenges in generating alpha, not only for yourself but overall for the industry?
No, I'm happy that it has been enforced on the entire industry. Once it is enforced on the entire industry, it brings a certain amount of symmetry. The challenges of generating alpha will depend on each fund house. And then the challenges of alpha generation have already started in the industry. If you look at the industry, beating the benchmark in large caps have been a challenge for some time. In the last 3 months, beating the benchmark in the mid cap has become a challenge. So that challenge is a separate challenge to the index, but it's a good move from the regulator, and I'm happy that it's enforced across fund houses.
Sure. If I had to ask you one investment theme that you would watch out for 2018, would you stick with pharma or another theme that you would want to give us?
No, I would really think that it's great to start building positions, long positions on pharma. I think we will see our portfolios also aligning to that in due course of time. But at this moment, we are happy with our allocations. We are not changing any broad allocations in our funds, and they stay what they are. And we also have been very bullish on the consumption theme for 5-6 years now. If you look at the market, our consumption fund has stood out as one of the top performers last year, and we remain bullish on consumption too.
Sure. One last question. What are your expectations from the budget and one key sector that you're watching out for in the context of the budget?
No, I always am very keen to watch out the financial services because I belong to that segment. We are seeing that particular piece now broadening with new avenues to invest, and I am always very bullish on financials as such as a human being. So I would really watch out on that segment if there are any changes on that. And then you see, the budget is made out to be a great event in the history of it, but it's just another sort of ratification of the overall process which it will anyway follow. I don't see any major significant changes in the budget as such. I hope it follows the path laid down by this government, and the path has been pretty constructive. And if we follow that same path, a lot of good can happen to all of us.
Well, that was the comment on markets. Now it's a muted day of trade for the European market. Let's head across to Yuan Pot, who joins us from the London studio with the complete lowdown of how the market action is panning out in Europe. Over to you, Yuan.
Hello from London. European stocks have steadied this morning with investors looking to put yesterday's sell-off behind them. We're also seeing some dollar strength. It's up for a third day in 4, and the yen pairing some of yesterday's gains. Now we're just over 2 hours into Europe's trading day, and a bit of a mixed picture around the region. Italy's FTSE MIB gaining 0.4%, but the Swedish market, it's down 0.3%. Volumes about 20% higher than average for this time of day, but so far struggling to find direction really on the equities front. On the bond markets, the yield on 10-year US Treasuries is down today. That's after China said that a news report on officials having recommended slowing or halting purchases of those US Treasuries might have cited a wrong source. On the FX markets, the Canadian dollar and the Mexican peso both adding to declines. That's been triggered by a report that Canadian officials see rising odds that the Trump administration will quit NAFTA. West Texas crude oil unchanged today above $63 a barrel, but oil still near a 3-year high. It's up by 3.5% over the previous 3 sessions. That's as inventories in the US dropped by 4.5 million barrels last week. That's the 8th consecutive drop. Back to you.
Okay, that's about the European markets, but let's move on. The automakers have had a blast in the month of December, clocking double-digit hike, I guess, and we've seen the auto stocks also doing well. Double-digit sales, in fact, were seen across the board, commercial vehicles. However, leading the charge with over 50% growth, but heading into a new year, what's on top of the auto industry mind? Listen in to the Deputy Director General at CM, Sugato Sen.
I think if you look at the projections that we did in April, for passenger vehicles, we said 7 to 9, now we are talking about 9. So it's not really an upward revision. For commercial vehicles, we had really erred. I think we talked about 4 to 6%. We have done 13%. Nobody is unhappy. We are all happy because we think that the commercial vehicles took the maximum time to recover from demonetization. Demonetization happened in 16 November.
Right.
And 17 November, we have done well. In fact, the previous month in October, we did very low growth. From November and December, we have really grown 50% plus, and that has resulted in taking the commercial vehicles out of the problems. And I think we are all happy. If you look at the two-wheelers, three-wheelers, all the categories, we have done more or less what we had said. There is not really much of a thing, but we are going to end at the higher end of the projection.
So would you say that at the beginning of the fiscal year, projections were more modest, considering you realized that the country was still reeling under demonetization then, and GST was just 3 months away at that time?
Yeah, I won't say our projections were modest. In commercial vehicles, we had not been able to anticipate this kind of recovery. But in all other categories, we have done fairly good projection.
Right, so we're at the end of this fiscal, and my next question to you would be about SIAM's and the auto industry's expectations from the budget. Could you give us, say, 2-3 key takeaways, key expectations that you have from the budget?
So in budget, first of all, every year in budget we discuss about the indirect tax, the excise duty, etc., etc. But this time, because GST Council is continuously sitting and they are addressing the indirect tax issue, that has been out of the budget preparation exercise. So we are left with only the direct tax and the import duty. We have talked about both direct tax and import duty, not a very significant recommendations, but we have talked about that please do not reduce the import duty on CBUs, the complete built unit. Please keep it at the same level for passenger vehicles, two-wheelers and others. For commercial vehicles, we have said that, in fact, the duty should be increased from current 20% to 40%, because actual duty is 40%, but through an exemption route, the government has kept the duty at 20%. We are saying that please go to the 40%, what was originally announced. And we have, in fact, in WTO also, our bound rate is 40%, so we can easily go up to 40% and keep it at 40%.
The 10-year U.S. Treasury yield climbed to the highest level in about 10 months, leading Bill Gross at Janus Henderson Group to declare a bond bear market. In a conversation with Bloomberg's Tom Keene, Gross says he's now short the U.S. bonds.
We've gone short bonds, not just treasuries, but short gilts and short bunds, left the JGB market alone. But, you know, it appears that it's a treasury phenomena and treasury directed based upon your Bloomberg report this morning with China being disaffected with U.S. treasuries, and your report a day or two ago about JGBs and their change in quantitative easing policies. But nonetheless, you know, it appears a negative type of posture for bonds. I've also gone rather negative on high yield bonds and credit spreads because, you know, as yields rise, you know, zombie-like corporations pay higher yields and their spreads are compressed and their their cover is compressed. And so this is not a favorable element for high yield bonds or sovereign bonds. And it's not a favorable element this morning, at least for the dollar.
You worked for years and you built for years a small shop that had enough mass where the Chinese worried about the Pacific Investment Management Company. Give us your experience of what China's doing at the margin with their treasury obligations.
Well, they certainly haven't been building treasuries, and recent evidence over the last few months suggests that they've been liquidating treasuries, supposedly in an effort to more diversify their portfolio, perhaps. In any case, the liquidation of treasuries as opposed to the accumulation of treasuries by China over the past few years is certainly a negative. And one of the things mentioned several days ago by your reporters has to do with quantitative easing, to the extent that the Japanese are less easy in terms of their purchases of JGBs, to the extent that the ECB at some point later this year pulls back. We've got a worldwide situation in which central banks in total, add in the Fed that's actually reducing their portfolio, in which the world central banks in total are not adding to their portfolio like they have in the past. There's been $14 trillion worth of bonds bought by central banks in the past 4 to 5 years. That appears to be close to an end.
Bill Gross, given your negative view on high yield and sovereign debt and so on, so where should investors go for yield right now?
Well, that's a good question, because a dramatic rise in yields, and I'm not suggesting that. I've suggested that once we broke the 240-45 barrier on the 10-year, and it appears that we have, which is a long-term trend line over 25 years, that the increase is likely to be mild. I think 10-year treasuries could approach 2.7, 2.8% by the end of 2018. And what does that mean? That means another 2 or 3 points loss, and it basically wipes out all income for the year. It's not a bear market per se, but it's certainly not a bull market. To be technical, bear markets bottomed in 2012 and June of 2016 at 145, and so we're 100 basis points plus higher. That could be defined as a bear market, but I think more legitimately, because bonds, for those years did still 3 or 4% based upon, high yield total returns, that, the bear market that I'm talking about is a mild one, but it includes, negative prices for high yield bonds.
So that was the view on US Treasury. Now moving on to the update from India. The government recently imposed a 70% import duty on imported solar cells. This is what they claimed would protect the domestic solar industry. But the industry body is now protesting against this move, saying this would make them uncompetitive. Anindya Upadhyay of Bloomberg News, who has been closely tracking these developments, joins us on the show from Delhi. Anindya, what is worrying the industry?
Well, there is protest from strange quarters. The imported duty, the safeguard duty on solar cells and modules was supposedly to protect the local manufacturing industry, but someone got blindsided by the fact that 60% of solar cell manufacturing domestically takes place in special economic zones. This is exactly what local industry bodies are pointing out, that these manufacturing units that are located in the SEZs do not have customs laws applicable on them, and this has caught them unawares, because the import duty, the safeguard duty on the imported cells and modules would be applicable to them, and it would make their produce expensive. So on one hand, the safeguard duty was supposed to protect the local industry, but on the other hand, it seems like a lot of people, including local manufacturers, do not see that benefit coming to them. Obviously, there are two fallouts of this. One, a large part of domestic manufacturing may not benefit from this safeguard duty. On the other, it will make imported solar cells and modules expensive, which is going to in turn increase solar tariffs for India. Back to you.
Right, and India, thanks a lot for bringing all those details. Well, moving ahead, the shale revolution is offsetting force to the strongest economic growth witnessed since 2004, says the global head for commodities at Goldman Sachs, Jeff Currie. In a conversation with Bloomberg, he adds that a further rise in oil prices will prompt central banks to respond to the inflationary pressures. Here's a slice of that conversation. Listen in.
Offsetting dynamics here. One is that we look at the underlying economic background. It's one of the strongest global synchronous growth backgrounds we have seen since the 2004 era, where commodities really went sharply to the upside. But the offsetting force to that is this new oil order, meaning the shale revolution is still very much underway, putting downward pressure on long-term oil prices. So while you have upward pressure on the front, you have downward pressure on the long-term price, which is creating a rotation in the oil forward curve, is creating a term structure, what we call backwardation. And that's really where, while we expect oil prices to remain flat to maybe slightly down here, the investment returns we think are going to be significant, really being driven by the shape of that forward curve. Investors go out, buy at a discount, roll up on the front end. So prices potentially flat to down, but upside in returns driven by curve shape.
Right, but how long can that last? And I'm also looking at research, for example, Citigroup saying that wildcards, including war or Middle East tensions, could drive crude to $80 a barrel.
Well, I think the key there is to get up to $80 a barrel, you would have to have that back end of that forward curve become unanchored. And if you think about 1 year out right now, it's trading around $61 to $62 a barrel on a Brent basis. You look at the cost structure of this industry, it's still in that 50 to 55. That gives significant returns to producers who are going to sell the back end, anchor it, which is why we think the upside from any of these disruptions around the world will be captured in the shape of the curve, not in the price itself.
Okay, is there a sweet spot for OPEC members? If OPEC members see prices rise, for example, Brent above $60, does that not mean that shale producers come back online?
Well, again, it's because it takes time between when the investment occurs and when you get the production. The key is really where the forward price is, not where the spot price is. And I go back, forward prices 1 year out are trading somewhere around 61 to 62, cost basis of 50, 55. That's what they're targeting. If you can keep that back end anchored, that front end can do whatever it wants, because the investment in the shale does not take place on that front end price, but rather on that back end price. Now, in terms of where do they want prices to go, getting too far above 70 starts to create the risk that central banks respond to the inflationary pressures off of higher oil prices. I would tend to think that OPEC members do not want to see that, and that in general we'll probably see more noise and rhetoric if prices trade above $70 a barrel in the coming days to push this market back down to lower levels. But I think the real key here is look at those forward prices. Where are they anchored relative to the price? Yeah. Because that's the signal for investment, not the spot price.
Jeff Currie, I know you read the price cover to cover decades ago, Daniel Yergin's one-volume must-read on the oil business, and it was about the advent of a cartel. What's the state of the cartel in 2018? And much more importantly, is Saudi Arabia going to drive the bus 5 years from now?
Well, if you look at the shape of the supply curve for oil, before the shale revolution, it was very steep, meaning it was very sharp upward sloping. And if they took supply on and off the market against that supply curve, it would do what? It would make prices go up and down significantly. Today, the oil market is a perfectly competitive market. Remember in Econ 101, you drew the supply curve and it was perfectly flat? Look at the oil supply curve today. Because of the shale revolution, it's very flat. We have your classic Econ 101 competitive market in oil, which makes it very difficult to operate a cartel. So why are you asking, why are they successful right now? I think one of the key issues here is that investors have had enough with the U.S. E&P sector. They've massively underperformed. The access to capital is relatively low right now until they restructure themselves. This is providing the window of opportunity for OPEC to act, but given where prices are right now, there's a very high probability that the sector will get access to capital again, and then the threat of that near-term shale starts to become real.
Which country or countries at the margin are you watching for 2018? There's always that outside summation of countries that can be an exogenous shock. Who are they?
Well, the big candidates that people are watching right now would be Venezuela, Nigeria, and Iran.
Yeah.
And I would argue, though, that that when you look at the ability for them to create a upside price spike, the market is more vulnerable today than at any other point in time. It's because inventories are low, and it doesn't take much of a shock. Let me give you an example. If a refinery has 10 days of inventory in its tanks, and if a tanker says, hey, I'm late to do some type of disruption, 7 days late, it doesn't matter. But inventories are down to 2 days late. That same tanker says, I'm going to be a week late. That extra 5 days, they got to go out and replace that oil. That's what really creates the upside, why the market is vulnerable today. But what that will do is will create a spike in the front end, create the backwardation, but the back end of the forward curve won't move because you know that tanker is going to come in. And I think that's the emphasis here. We're getting backwardation, something we haven't seen since the 90s, and that's going to be the real opportunity for investors here, not price appreciation.
Jeff, Carl Weinberg also has a question for you.
Yeah,
Carl, please.
Two quick questions, actually. About those inventories, IEA data show that inventories are running about 8 to 10 days of supply, or about 500 million barrels above normal. All right, how does that affect your view on prices, and why isn't that keeping prices down? And the second one is, I just wonder if you have a view on petro yuan and how that affects the market.
Okay, well, I think, going back to the inventory levels, as we draw those inventories down, the curve gets backwardated. And if there was one thing that's almost a law within the commodity space, lower inventories lead to backwardated forward curves, meaning that the spot price sits above the forward price. That is the carry that you see in commodities, and that's where we expect returns to be generated from owning commodities. As the inventories get tighter and tighter, the market gets more backwardated. I want to emphasize, why does it stay backwardated? Let's go back to my example. I have 10 days of inventory in my tanks as a refinery. That tanker calls in late by 7 days. I'm not going to bid up the front end, and I'm definitely not going to bid up the back end because that tanker is going to get there. But in the environment in which I have 2 days of storage sitting there, that tanker calls in 5 days late, I'm going to have to buy oil today, but I'm not going to buy next week's oil, but I'm going to buy this week's oil, which bids up the front end but does nothing to the back. And that roll yield is really critical to generating returns from owning oil. And that's what the benefit from the low inventories to the investor is going to be.
With that, it's a wrap on this leg of Countdown from Navneet, Pradeep, and me, Neeraj. Thanks so much for watching.